Okay, hi, good afternoon. This is Mayor Walensky with Driving Markets. All right, so we're going to do a session on liquidity. In light of what's going on in financial markets with the extreme tension and a major banking crisis forming, some people say it's not a major banking crisis, it's only a minor banking crisis, but we'll discuss that a bit more in detail. I thought it would be pertinent to give a YouTube broadcast, correct my camera, a YouTube broadcast on liquidity. Okay, so I've had some comments and I've had some feedback and I've had some clients say, some viewers say, can we speak more about liquidity? All right, now it's probably right to speak about liquidity at this moment due to what's going on globally with the banks and obviously the headline news regarding Silicon Valley Bank and Signature Bank, and of course the less known bank, which was a Silvergate crypto bank. All right, so before we go into what's brought on this particular crisis, let's go a little bit back. Let's step back in time to where the liquidity crisis actually really started. So the liquidity crisis started with the banking crisis of 2008, 9 and 10. If you remember back then, the major banks, which were the Morgan Stanleys, the JP Morgans, the Goldman Sachs, the Chase, the Bank of America, then it was Lehman's, Bear Stearns, to name but a few, including Barclays, RBS, Nationwide, banks all over the world got involved in a liquidity crisis, okay? And that liquidity crisis really started already a few years beforehand when they were doing mortgage-backed securities, where they were doing faulty mortgages or subprime mortgages and just lending money to anyone who had a pulse. It doesn't matter if they fulfilled the criteria of having a mortgage, if they didn't fulfill the criteria, if they had money, didn't have money. Back then, back in the early 2000s and late 90s, the banks were so keen to lend money and build up a mortgage book that they lent money effectively to anyone. That all came to a head, an explosion, back in 2008, or really in August 2007, when Countrywide, which was one of the mortgage lenders then, issued a notice that their defaults had increased dramatically. All right, no one really paid attention back then to that small crack within the mortgage market. All right, now what exactly happened is that Countrywide informed the authorities that their default rates have increased. And that continued all the way through to 2008, where eventually there was a massive implosion. It was actually 2008, 2009, beginning 2009, where Lehman's went bust. So Lehman's was a huge bank. Lehman Brothers, been around for many, many, many years. They went bust, and so did Bear Stearns. And the Fed did not come in and rescue them. However, the Fed did come in and rescue all the other banks, okay? So they rescued all the other banks, which was the JP Morgan, the Morgan Stanley, the Goldman Sachs, the Chase Manhattan, Bank of America, to name but a few. I mean, there were multiple banks. And what did? They started to print money, okay? And they printed money, like all the banks, not just the Fed in the US, also in the UK, in France, Germany, Europe, Far East, etc. Money was printed and given over to the banks. Why? Because the banks effectively were bankrupt, okay? So they gave this huge amounts of money over to the banks, huge amounts. We're talking about billions and hundreds of billions to refloat the banks, to give them an opportunity to cope with their huge losses and the huge amount of toxic debt. And what happens is in the US and in other countries, the central banks bought back the toxic debt, seemed to put it in sort of little compartment somewhere, and all of a sudden JP Morgan, Morgan Stanley, Barclays, RBS, Lloyds, all of them are super banks now because they've just been pumped in with money. That liquidity, that pumping in of liquidity, pumping in of money continued all the way through to 2021, really 2022. Now, if we fast forward through to 2022, the seeds of inflation were planted already back in 2010, that once you give liquidity over, once you pour money and pump money into an economy, then you're really sowing the seeds of inflation. And that came to bear in 2022 as a result of the pandemic and as a result of lockdown, close down, no economy working, And then when the economies opened up, there was such a high demand for goods and availability of cash that further had been pumped in by central governments into the consumer's pocket to get them to go out there and spend and buy and to keep those big companies working. Then the demand shot up through the sky, okay, to all-time highs, no doubt, and supply was not able to keep pace with demand, and that was the start of the fruition of inflation. But the seeds were already planted previously back in 2008, 9, 10, throughout the last decade. Okay, so the pandemic aggravated and frustrated the mechanics whereby you already had inflation brewing prior to the Russia-Ukraine war. The Russia-Ukraine war frustrated it more by sending up commodity prices and oil, etc. And then those prices have subsequently come down, and Russia and Ukraine are still at war, but you'll see that the commodity prices are lower than they were at the beginning of the war, and oil's also floated all the way back. All right, so we can't really blame Russia as much as Biden wants to blame Russia. That's not really having such a major impact on inflation, as is the supply line and the high rising cost of food and raw materials and production of those goods, and also exploitation by manufacturers of having reduction in those commodity prices and not passing it on to the consumer. So that's a little bit of background as to liquidity. Now, every country and every operation, every business needs liquidity. They need money flowing through it. Liquidity, or cash flow, which is another name for it, is constant cash flowing through the business. That is the oil that's the vehicle that oils the system. That's the method of oiling the system, by having a lot of cash flow. As soon as there's no cash flow or limited cash flow, then that generates the potential to be a liquidity problem, not necessarily a crisis, a liquidity problem. If we now go on to where we're at in today's particular moment regarding Silicon Valley Bank and Signature and Silvergate Crypto Bank, and of course there's some others that are going to fall as well, or likely to fall, then we are now in a liquidity crisis. Why we're in a liquidity crisis? Because interest rates went up in 2022, beginning of 2022. In fact, on this channel we stated clearly that interest rates were going to go up significantly. Not only did interest rates go up, but the governments began to pull back their quantitative easing, or the printing of that money. And as a result of that, that caused a contraction of available money out there. Why? Because as interest rates rise, there's more money being paid out, laid out, in order to finance your business. You're paying interest, higher interest for your loans, for your finance, for your cars, for your mortgages, for your business, etc., etc. And most businesses run on some sort of credit line or some sort of overdraft facility. Okay? So once that's been taken away, in addition to that, there's less money being pumped in by the governments. You're developing and producing and manufacturing, or not even manufacturing, you're processing a liquidity process, developing a liquidity crisis. Now, a lot of the money over the last few years has gone into cryptocurrencies. That's the new big high-risk asset. It's like a roulette table or casino. Everyone just jumps in there and says, yes, Bitcoin, Ethereum, and all these cryptos are going to go through the roof, and they're going to replace effectively hard currency. That's unlikely to happen, but I can see the theory and the views behind that. Now, a lot of banks got involved with providing cryptocurrency services. One of them was Silvergate Crypto Bank, which loaned money based on cryptos, allowed people to deposit cryptos there, and was general financier for the crypto service industry. The other bank, which came to light only recently, which most of you never probably heard of, is Silicon Valley. Silicon Valley also was facilitated venture capitalists, startups, and some of the crypto industry. The other bank is Signature Bank. Signature Bank also had exposure, finance, and supported the crypto industry. So you could say the crypto industry was partly to blame, if not all to blame. Well, not 100% to blame. What actually brought down Silicon Valley Bank is that they had a $21 billion investment in US Treasuries before interest rates went up. Why? Because they wanted to use some of that capital, or secure some of the capital that they had accumulated within their asset management, and they put it into what? secure investments like US Treasury bonds. You couldn't get more secure than that. However, as January 22, February 22, March 22 moved on, the price of those US Treasuries dropped and the yields went up. Okay, so since the price went down, then you had Silicon Valley Bank was now having a paper loss on their US Treasuries. They bought at this level and now the price is this level and they're furnishing a loss. The loss is out precipitating into a significant loss until we got to March 2023 when their loss had really come to around about $2 billion on those US Treasuries. And then they issued a cash call to their investors saying we need $2.25 billion to shore up this loss within our US Treasury exposure. And as a result of that, that frightened the markets, and the venture capitalists and the analysts issued a note to their customers, pull your money out of Silicon Valley Bank. And that is a run on the banks, or a bank run. A run on the banks is when you get lines of people, like in 2008, stand outside the bank to withdraw the money. Okay, that is a crisis. That is a crisis. Why is it a crisis? Because it generates a lack of confidence in the banking system. One other bank which came to light on Friday when the shares dropped 23% was Signature Bank. And Signature Bank also exposure to the crypto sector, also exposure to US Treasuries. No one knows what they were invested in and is there risk. There was a run on that bank as well. So people were standing outside to pull the money out of Signature Bank. As a result, Joe Biden, the Fed, the US Treasury, came in, said we will support those deposits above up to 250 and above 250,000 to calm down the markets. However, there are other banks that are now at risk or being looked at under a microscope. One of them is the First Republic Bank, okay? Then you've got Charles Schwab, the brokerage, which shares fell significantly intraday yesterday, 23%, and they closed down 12% because no one knows their exposure on other assets. Even though they're claiming they've got plenty of cash and they're absolutely fine, at the moment they're being checked out and they're being analysed whether they are going to survive. You've got Zions Bank, you've got Westpac, you've got Co-America, so you've got a lot of small banks that are being tested now, and the customers are nervous. Is their money safe? Now, what one of my colleagues highlighted is that, interesting enough, that as these banks close down, those customers will need to run to another bank. So therefore, he's particularly looking at which bank shares are going to now increase or looking good value. Okay, so you could have the Citibanks, could have the Bank of America, Chase, Morgan Stanley. You could have other banks that operate, Wells Fargo, that operate individual accounts for clients, and you could find that there could be a run to those banks. Now, Wells Fargo went down because Wells Fargo also is heavily invested. No one knows what their exposure is. So the real fear today is what is the exposure of the banks to assets or investments that have not done well and expose the bank to severe cash flow difficulties. That is a breach of confidence as a result of liquidity issues. You know, the bank doesn't have enough money to fulfill the demand of its customers and or shore up its investments. So liquidity crisis comes as a result of rising costs of money, interest rate, okay, poor investments, and not only poor investments, a dropping in the asset value of the assets that are held by that particular bank, whether they are in property or whether they're in liquid assets like bonds or shares. By the way, on property, I'll do a separate session because I do believe property is going to fall significantly, but that's a separate session. Okay, so that's really a liquidity. Liquidity crisis is when the cost of money or availability of money is simply either too high cost of money or no availability of money. That causes the banks to go into liquidity crisis, and that sends a shock of confidence or breach of confidence, break in confidence to the consumer, the retailer, the account holder. He runs to the bank to withdraw his money as fast as possible because he doesn't trust the bank. So hopefully that's captured a lot about liquidity, and it's a bit of an explanation. Hopefully it's not too long, it's about 15 minutes, and it can be referred to going forward. All right, this is Mayor Walensky with Driving Markets. Have a good day.